we'll get into the next subject, which is the equity investment, which from a level 1 standpoint constitutes around 10% of the total weightage, right? Whereas probably the level 2 occupies the highest weightage for this equity investments. Probably in level 2, it goes even up to 20 to 30% kind of a weightage. So, the level 1 focuses primarily on the conceptual aspects relating to the equity securities, equity markets, and some basic valuation mechanisms and very basics kind of stuff. Whereas in level 2, it entirely deals with the valuation aspects itself. How do you value a equity security? So, from this standpoint, this subject has been allotted 6 different readings. And the first of it is understanding the market organization, equity markets. It's a complete financial market here. It's just not the equity, the entire financial markets. How are they organized and what is their structure? So, to start with, whenever we talk about a financial system of a country, right, in India also, if we see the typical financial system, every person or every company should be able to do these kind of activities very effectively. That is where we say the financial system of the country is efficient. People should be able to save their money, and corresponding to the saving, they should be able to get some kind of return. The people should be able to borrow the money at least quite comfortably from various sources, and companies should be able to raise equity capital for running their businesses. That is what we constitute the entire financial system of the country, where there is some kind of saving process, borrowing and lending process, investing in the form of equity capital, and people should be able to people or probably the lender should be able to assess the risk of the various parties, and they should be able to do a proper risk management. And even the buying and selling, the transactions process should be very much efficient. So one party should be able to pay, which means the rupee or whatever is the currency, it should have some meaning associated with it. One person should be able to give some currency and he should get some kind of asset in exchange for that. So all these things, and that too, the information efficiency should very much be there, which means probably the news and corresponding to the news, people buying more, selling more, such kind of transactional efficiency or informational efficiency is also very much important as a part of any financial system. So, if all these things are very effective in any particular country, we say that particular country's financial system is more and more efficient. Right? Whenever people want to save, they should have avenues to save, and corresponding to that saving, they should be adequately compensated. Whenever people want to borrow, there should be some mechanisms, either banks or some other sources. So there should be a kind of balancing across, and for the bank, they should have another mechanism of investing that money. So it's a kind of a rotation process that should be there as a part of the system. On that entire thing is what constitutes the financial system of a country. And whenever we talk about efficiency associated with the financial system, we talk about all these things to be pretty much comfortable for each and every participant in the system. Now, if we see some of the typical markets, we can classify them under various criteria. Financial assets versus real assets. Most of the transactions, when I say financial assets, we have stock markets, we have bond markets, which are purely financials. We have a derivatives market, purely financial assets, which means they don't have a physical presence, purely accounts kind of transactions, right? Money from my account goes off, my demat account is credited. So it's purely from that standpoint. Whereas when I talk about a real asset based market, probably commodities or real estate, where are gold, I'm possessing something. Some assets are physical in nature, which I can buy and sell. There is a mechanism to buy and sell those kind of stuff, as well as financial assets like stocks, bonds, mutual funds. These are the various financial assets that are possible where the buying and selling of those things is possible. Then we are also talking about the markets, debt versus equity, where there is a lot of loans given versus equity investments done. So there are some companies which raise capital through loans, some companies which raise capital only through equities, some companies which do through both the mechanisms. But markets wise, see, once they raise the capital, those particular shares or bonds, they are traded on the capital markets like stock exchanges, or in these kind of avenues, they are tradable. So the securities wise, we can come across debt versus equity kind of securities. Some kind of securities are there which are exchange traded versus private, right? Probably real estate. We don't have any exchange for real estate transactions in India, right? It's purely between two parties. Whereas for stocks, there is an exchange. There is a Bombay Stock Exchange, or a National Stock Exchange, or any of these kind of exchanges that are present. So we have those kind of some securities are traded over the exchange, whereas some of them they are traded, they are private, and the transactions are merely between two parties. So even that kind of a classification we can see for the markets. Then okay, derivatives we haven't touched upon still, but in the derivatives markets also we have the derivatives on financials, like probably there are derivatives markets dealing with stocks, stock derivatives, stock futures, stock options, or probably index futures. These are all financials, like bond futures, or probably the interest rate futures, currency futures. These are all typically the non-physical, which is more of a financial derivatives kind of market. Whereas we also have a physical derivatives market like gold futures, commodity futures, commodity options. These are all going into physical derivatives kind of market. So we have markets for those kind of securities. We can also classify as spot versus future delivery. Derivatives markets are all future delivery markets. Whereas spot is probably I'm buying and selling any. I can buy a currency today. I can buy commodity today. A lot of transactions can happen today, and if the same thing happens in future, we call it as the derivatives market. So the detail we'll look at it when we talk about the derivatives, but simple word for derivatives markets are typically the future delivery kind of markets are all classified under the derivatives kind of markets. Then we have a primary versus secondary market. All IPOs and all come under the primary market, whereas exchange traded kind of things, once the security is issued, the trading that happens on it happens in a secondary market. But the first time when a share or a bond is issued to the public, it comes under the primary market, where the direct interaction comes from the company to the public. Whereas after that, it is purely traded on the secondary market. So we have some primary markets, some on the secondary markets. Then there is a classification on money market versus capital market. Money market is all trades which are maturing within less than 1 year, like treasury bills, commercial papers, certificate of deposits. We have seen in our working capital management chapter various kind of money market instruments that are available. So all these things versus capital markets is wherever the investments are typically for a longer term period, stocks, bonds and all, they get classified under the capital market kind of securities. Then traditional investment markets versus the alternative investments. Traditional investments are generally the stocks and bonds, which are typically covered by CFA. Whereas alternate investments market, they are just touched upon by CFA, but not heavy depth into the alternate investments markets, whether it is real estate or commodities or hedge funds or mutual funds, right? These kind of things, they are just touched upon by CFA as I mean, in mutual fund you can very well create again a combinations of everything. I mean, they come again into the traditional market also as well as into the alternate itself. But all these real estates, right, or you can talk about all commodities, they all come under the alternate private equities. To some extent, they come under the traditional also, but they are slightly different from traditional, the way they operate. So they all come under as a part of the alternate investments kind of markets. So CFA just touch bases the concepts of all these, but not more in depth. Now, when we talk about different types of instruments, earlier we have talked about different types of markets. Now, when I look at various types of instruments that are available in different markets, we call them by different names. Securities is something which is more to do with financial assets. We call them as securities like bonds, equities. We call all of them like mutual funds, which are more of financial related stuff. We call all of them as securities. The very common word. See, for agricultural and physical things, we don't call them as securities. We call them as commodities. So security is something which is more to do with a financial asset kind of stuff. Either the fixed income securities like bonds and all, or equity securities like common stock or preferred stock kind of stuff, or it could be pooled vehicles like your mutual funds, hedge funds, any of the funds. They all come under the various securities for us. Then we use a name called contracts, especially for derivatives and insurance. All the derivative products like forwards, futures, swaps, and options, we call them as contracts. They are not securities. We call them as contracts because they are merely nothing but agreements. Agreements for buying and selling something in future at a price decided today. So they are merely contracts, and insurance is also more like a contract. So we don't call them as securities kind of word, we call them as contracts. Then we also have commodities. It could be agri commodities or industrial commodities or even precious metals. They are all different kinds of commodities. Agricultural, generally we have all these bajra, maize, corn kind of commodities all come under agricultural commodities. Then we have industrial commodities like iron and zinc, nickel kind of, which are heavily used as a part of industry. Then we also have precious metals like gold, silver, platinums kind of commodities, and even energy products like petrol or oil, natural gas. All these things come under the energy kind. All these commodities, they are traded either in the spot market or in the futures market also. Most of these commodities are traded even in the futures market also, and you can very well buy them in the spot market also. So both markets exist for almost all these commodities. Then the fourth set of instruments we always deal with is the currencies like dollar, pound kind of euros and all. Even for them, you can buy in the spot market or in the futures market. You go to any dealer, he'll give you dollars immediately for the rupee, that is the spot market. Or you can enter into a forex foreign exchange, and you can go for buying it after 1 month, but fixing the deal today itself. That's like a forward market kind of stuff. Then we have, in the entire financial system, we have some intermediaries also, like your brokers. Okay, there is a difference between the broker as well as agents in a lot of scenarios. When we say brokers, they are always uh, they are the connectors between the buyer and the seller. Generally, they represent the buyer. Right? When I say I'm a broking firm, you work on behalf of your customer. You place the trades on behalf of your customer. Right? Any broking firm, they try to connect. They are not the employees of The seller. See, that's the key difference between a broker and an agent always. Whenever we talk about an agent, the agent primarily represents the seller. In insurance companies, we use the word called agents because the agent's job is primarily to work on behalf of the seller. He works on behalf of the insurance company. Whereas when we say broker is an independent entity who will be a middleman between the buyer and the seller, and he will charge based on the he will charge a commission based on some amount. He may charge the buyer, or he may charge the seller, or he may charge both the parties. For different scenarios there could be different. Whereas if it is an exchange, we are talking about, it's a centralized location. Exchange is nothing but it's a physical location where buyers and sellers get together and execute their deals. Like BSC, there is an office for it. There is a physical location for BSC where buyers and sellers get in there and use various mechanisms to execute their trades. Whereas the difference is, see, for some markets we have only dealer driven. Dealer driven is the dealer is also an intermediary like a buyer, like a broker, but the dealer will match the orders at different points in time, whereas the broker will match the orders at the same point in time. Let's say we are talking about an ICICI Direct, who is a broking institution, right? Probably the seller order and buyer order are matched and a sale is executed. So the dealer is not, the broker is actually not getting into he buying it or he selling it. He is only connecting the two parties. Whereas when we say someone playing the role of a dealer, even for your physical commodities, we talk about people, right? I'm a Sony TV dealer. What is the typical name? What is the typical meaning that is coming out there? He sells from one. He buys from the seller. He sells it to the buyer. And these two could be at different points in time altogether. Those are what are called as dealers. Even if you typically see the forex market, it's a purely a dealer driven market. You go to you go to Western Union money transfer, they may give you a different rate for $1. You go to some ICICI bank, they may give you a different rate for $1, because all these are various dealers for forex. So they facilitate, they buy at some price, they sell at some other price. And they may buy a different volume, they may sell a different volume altogether. These are the typical players. So that's where we are saying matching the buyers and sellers at different points in time. Some markets, they are purely dealer driven markets only, like the forex which I was talking of. It's not one single price. If you talk about a stock market, the buyers and sellers, there is only one price at any point in time. As long as you are trading on BSC, it's only one point at any one price at any point in time. The trade gets executed at that. Whereas when we are talking about a dealer driven market, each dealer has a separate price at which he can buy, at which he can sell. Those are the dealer driven markets. So there are some dealers for some kind of securities. There is a centralized location for some kind of securities, which is an exchange driven kind of securities. Then we also have arbitragers. Arbitragers are more like people who are making a profit without any risk. Riskless profit makers. Like they observe the mispricing of the same security in two different markets. Let's say the stock. On NSE it is having a separate price, and on BSC it is having a separate price. The same stock, probably because these two markets operate independently. So if at all someone notices that the price on NSE and BSC is slightly different, he may try to exploit that kind of a difference and create a profit for himself. He will buy in this market, sell in this market, or vice versa, and immediately create a kind of profit. Such kind of profit, because it is immediate, There is no risk of stock price falling or anything. He is assured of his profit. Wherever there is an assured profit, we call that kind of without any risk. Assured is without any risk itself. Wherever there is an assured profit without any kind of risk, we call those kind of participants in the market are called as arbitrageurs. The whole job of a hedge fund manager is primarily the role of arbitraging, right? So he has to identify the avenues where a profit can be made without taking any risk. It's like zero, probably, or the other way sometimes people talk about is with zero money of yours, make a profit. Without investing money, probably with someone's borrowed money, make a profit, but that too assured. So even after you refund back his money, you are assured of something extra, which means literally you are putting zero. You are borrowing money from some source at a known rate of interest. You are investing in some other source, probably let's say again at a known rate of interest. That is where you are making arbitrage profit. So probably it's like if someone, let's say you are my lender, you are lending me at 8% rate of return, right? I have invested the money in a bank which has assured me a 10% rate of return. My loss is nothing. I'll borrow why 100, why 1000 bucks. I'll borrow some 100 crores from you, right? I'll borrow 100 crores from you. I'll invest 100 crores here in the bank. At the end of 1 year, the bank will give me at 10%. So 10% of 100 crores is, let's say, 10 crores. I'll have to pay you back 8%. If both are fixed, 2% is my money. 2 crores is my money. With zero money of mine, I have created 2 crores. But in this whole process, identifying that opportunity of who is that scapegoat who can give me a loan at 8% interest, and on the other side, who is that one who is going to give me 10% rate of interest. So those are the participants whom we are calling as arbitrageurs. Then we also have depository institutions and securitizers. Like some companies, what they do is they create funds using the pooled kind of scenarios. They create some kind of fund. Like the typical thing is in US, securitization is a very strong concept also in terms of, let's say, there are so many housing loans, right? All these housing loans are packaged together, and bonds are issued with housing loans as the collateral, typically called as mortgage backed securities or any asset backed securities. So these are so there are so many companies that are existing who create instruments based on some kind of a securitization. So these are the various participants that are available in the financial market. We see that the insurance companies are available in the financial markets, and then we have clearing houses whose main role is work on behalf of the exchange to make sure that no party is defaulting. So basically, exchange should not default. So that's where it has kept a clearing house. So typically, any deal that happens on an exchange, it's like this. When I talk about buyer and a seller, exchange is coming here. So buyer buys from an exchange, seller sells to an exchange, right? In this process, the exchange makes sure, this is the clearing house in the exchange. What it does is, it makes sure that one, the buyer and seller do not know each other. You don't know who has sold you the share, you can still buy the share. because exchange acts as a counterparty for us. For a buyer, exchange is the seller. For a seller, exchange is the buyer. So it takes the shares from the seller into its own account, and it takes the money from the buyer, puts into its own account. So take the shares from its account and transfers it into the account of the buyer. That is where this entire process takes 2 business days or something, T+2 kind of transactions, because the exchange acts as a middleman, which is what is the role of a clearinghouse there, to make sure that this entire process, taking the shares from here, depositing it into the buyer, taking the money from the buyer, depositing it into the seller, something like that, the exchange has to do this entire task, and that is what is done by the clearinghouse within the exchange. Then one more aspect that is coming into it is from an investment or from a buyer's or seller's standpoint. Whenever we talk about the transactions in the financial markets, we always use words like long and short. We generally don't use the words like buy and sell. They actually mean buy and sell. When I say long position, it's as good as you are a buyer. Imagine that you are a buyer. Whether you have bought it or not, because if you are literally buying a share, then there is no difference between buy and long. But because of the various complexities involved in the financial markets, even without buying, you can create a buyer scenario. That is why we talk about using the word as long for buy, short for sell. Right? You don't need to literally pay money and buy it. Right? So that is what is the actual buy. When I say I'm long position, it could be assuming that I am buying also, because so it will talk about either the current ownership or even a future ownership of it. The same thing is in case of short. Either I can sell it today, or probably I can sell sometime in future also, or probably I can borrow it from someone, I can sell it. All these are packaged together as a short position. So whenever we are in a short position, the typical way to understand is a short position will always gain if the price decreases, because today I am selling it, probably I'm selling it with an intention that I'll buy it back at a cheaper price in the future. So I will gain when the price falls down in the future, whereas a long position will gain if the price goes up in future, because he is buying it with an intention that in the future it will go up and he can sell it in the future at a higher price. And that long position and short position also, we have a couple of more terms. One is called as a margin buy. See, buy with a literal cash is a cash buy. But in some cases, I can do the buying not with a cash, but with the money borrowed from the broker. Right? Today, most of the broking firms give this kind of a feature. If I'm putting $1,000, they don't mind putting another $9,000 and allowing you to trade for $10,000. Right? So your portion of your money is what is your margin. When you say I'm buying on margin, how much are you depositing? What is your money? And how much the broker is giving. So why is he giving? He does not give it at any interest also. Most of the cases he will give it interest free. Why will he do that? See, typically when you are buying for $1,000, assume that his brokerage is 1%. So he will get $10. But now what he is doing in this process, he is giving you another 9,000 to as a brokerage, as a margin. So you are able to trade with $10,000. And probably he'll say, no, I'll reduce the brokerage in case of margin trading. He'll try to put only 0.3%. But 0.3% is on 10,000. So he's getting $30 as his brokerage. So if he is getting that much high, there is no reason why he should charge any interest for the loan which he is giving to you. But and at the same time, if your position is going bad, if you are losing out, he will immediately close out the position. He has that kind of right in his hands where he can close out the position if things are going against. See, typically when you have taken 10,000 bucks to buy, the intention is the price will go up after you buy, right? Only then you can sell it off, pay back to the broker his 9,000, and remaining is your benefit. What he will generally do is, if the value, let's say you have done the trading for 10,000 bucks, if the value has gone to, let's say, 9,500 or 9,400 kind of stuff in the market, what he will do, he has to get his 9,000 back. So he will try to close your position, saying he'll take back his 9,000, and whatever the 300, 400 of your money, it is refunded back to you. But as long as it is going to, let's say, 11,000 or something, he will not interfere at all. The same 10,000 which you have bought, let's say after you have bought, it has gone to 11,000 or something like that. Now you can execute yourself, give him his 9,000, take your 2,000. Right? So in case of margin buy, the margin buy will be very much profitable if the price goes up after your buy transaction. But if the price goes down after the buy transaction, then it's at a loss. It's at a huge loss. So margin buying is one pretty common concept today as a part of the investment position. Right? The more and more margins I am taking, more and more borrowed funds I am working out with, the leverage is higher. Even in our leverage chapter also, we have typically looked at, the more and more borrowings I have, the more and more debt I have, the leverage is going to be high, which means if things are going well, I can make a huge profit. But if things are going against, I'm going to make a huge loss also in that transactions. So in any kind of a margin, whenever we use the word called leverage ratio, what it means is how much you are investing versus how much the broker has given. See, overall you have made a transaction of 10,000 bucks in the example which I was discussing. You put your 1,000 bucks. 1,000 bucks is your equity. You put your 1,000 because it's your money. 9,000 bucks is the loan which you have taken from the broker. Using those two, you are able to do a trade for 10,000. So whatever the asset you have purchased, asset is nothing but the shares or bonds or whatever you have purchased. Whatever the asset you have purchased is worth 10,000 bucks, whereas your equity is only 1,000 bucks. So you say my leverage is 10 times. The leverage ratio is 10 times, which means for whatever X amount I am putting, I can trade for 10x. Right? So for every 1,000 bucks I put, I can trade for 10,000. 9,000 will be provided by my broker. So if the leverage ratio is very, very high, it indicates that the risk taken is much, much higher. Now, the typical scenario is whenever we compute, let's say, well, how do I compute the return on a margin transaction? Let's say I have 1,000 bucks. Broker has given me 9,000 bucks. With this, I have the money of 10,000 bucks. Let's say I have, the share price is 100 rupees a share. Some share is trading at 100 rupees a share. Now I can very well buy 100 shares with this money. 100 shares at 100 per share is what I can buy. Now let's say at the end of the day, the price has gone to 105. The price has gone to 105. So at the end of the day, your total portfolio worth has become 10,500. 105 per share into 100 shares. 10,500 is your total worth of the portfolio. So you are selling it off, refunding your 9,000 to the broker. You will not charge anything extra there. If most of the times it is intraday. If it is intraday kind of stuff, you will not charge anything excess. So overall you are left with 1500. 10,500 minus 9,000. You are left with 1500. So with 1,000 of your investment, you are able to make 1500. So you had a 50% profit. Whereas if you had used a cash transaction, you would have got only 5% profit. So the leverage will give you such a kind of a benefit. But of course, if it had gone the other way, instead of 105, if it had gone to 95, you would have lost 50% of your money. With 1,000, right, the portfolio would have become 9,500. 95 per share, 100 shares, 9,500, refund 9,000 to your broker, you are left only with 500. So your 1,000 money has resulted in 500. So you have lost 50% there. So that is what is the risk associated with the margin transaction. When you gain, you will gain heavily. When you lose, you will lose heavily. In any kind of margin based transactions, if you are gaining, so there is nothing called intermediate or moderate there. If you gain, you will gain heavily. If you lose, you will lose heavily. But of course, in these things, here this is a plain transaction which we are talking of, right? But wherever the costs are involved, let's say if this is the transaction 10,000, probably there could be some brokerage, right? Probably 0.3% is the brokerage, 0.3% of 10,000. Right, there could be a brokerage, let's say 30 is the brokerage, right? So your total cost is becoming 10,030 because 30 is the brokerage also. Let's say if in some cases the broker is charging interest also, right? You have to pay back not just 9,000 but slightly above 9,000. So I mean, if those kind of information are given in the question, we have to accommodate those things wherever need to be added. Here it needs to be added initially, the brokerage to your total cost. But finally, what you will be left with when you are selling, even at that point, if there is another brokerage, when you sell also there is a brokerage, right? For whatever amount you are selling, there could be a brokerage associated with that. So what you are really receiving is after removing the brokerage. So if he is asking you to compute the return, the overall return in the process, you have to take even these kind of things into consideration if the question contains these kind of elements also. Then another key aspect in this regard that is worth considering is a maintenance margin. In case of margin transactions, there is a word called maintenance margin. Like in the same example, 1,000 plus 9,000. You have purchased 100 shares at 100 per share. Let's say the share price has gone to 95. So in the earlier case, what was your equity percentage? Equity percentage was around 10%. 1,000 out of 10,000. The contribution of your equity was around 10%. Now that is what is, let's say, your initial margin. When you started out, that is the initial margin. Now let's assume that it has gone down to 95. If it has gone down to 95, what is the position? Your equity position is 500. The loan is still 9,000. Loan will not come down. You have to refund the 9,000 back to the broker. Your overall portfolio position, your overall security position is 9,500 now. Out of that, 9,000 is the loan, 500 is your equity. Now if I have to compute my equity position, it is 500 by 9,500. The value of my equity right now, the proportion of my equity right now is 5,000 out of 500 out of 9,500. correct? Which is nothing but around just around I think 5 by so 1 by 19, so around 5 or 5 and 5.1 5.2%. This is what is my position of equity here. Now, till how long will a broker tolerate? Right? If it is falling down and down and down, the broker is now worried. Will his 9,000 be into a loss? So for that, he sets what is called as a maintenance margin. What that maintenance margin says, here he will set some percentage. Let's say 7%, right? Which could be 70% of the initial margin. 70-75% of the initial margin. What he will say is, as long as your equity position is more than that 70% of the initial margin, I will not do anything. But if it falls below 70%, like 7%, it has gone to 5.2%. Wherever it is falling below that 7%, I'll give you a margin call. What is that margin call? You deposit some extra fund. If you are not depositing any extra fund into your account, then probably he is going to close down your share, close down the transaction, take his 5,000, take his 9,000 back, and whatever is left, it is left in your account. So the broker ensures that he is not losing money if things are going in the other direction. So what is that amount which will attract a margin call in the same transaction? What is that amount that would have attracted a margin call? Because when we are doing this, it has got to 5.2%. So there I can very well see what is that amount that will attract a margin call using this kind of a formula. P naught, which is the initial price, which is $100. 100 is the initial share price, into 1 minus initial margin, which is 10%, divided by 1 minus maintenance margin, which is 7%. So probably it will work out as 100 into 0.9 by 0.93. Whatever is this amount, so probably 90 by 0.93. So around stock price of 96.77 would have attracted a margin call. Because it has gone to 95, it would have definitely got a margin call, and if the funds have not got replenished, it could have resulted in selling off the shares and probably taking back his 9,000 by the broker. So once you know the initial margin, the broker will always set a maintenance margin to make sure that he is not losing the amount which he has lent to the investor. So based on that maintenance margin, he will keep monitoring what is the equity position at each of the points. And using this formula, you can even find out at what point he will give you a margin call. If the stock price falls below that point, he is definitely the investor is definitely going to get a margin call, for which is more to replenish the fund. Otherwise, he is going to lose out on it. And the next thing is, there are some kind of different kinds of instructions that are available as far as the trades are concerned. There are some kind of execution based instructions, like at what price or how should the trade be executed. The most common execution instructions are the market order, the limit order, and stop loss order. What these orders are saying is, market order is execute the buy or sell at the current market price. Whatever is the current prevailing price, you buy or sell at that particular price only. When you say limit order, you set your own price. Buy if the stock price goes below this. Below this quantity, if the stock price goes, you buy it. Or if the stock price goes above that particular price, you sell it. So generally for a buy, the price will be less than the market price. For a sell, the price will be more than the market price. So that's also a kind of an execution instruction. You execute the trade at that point. Then we also have something called stop loss order, which is again executing a trade itself, but it will be opposite to your limit order. Like you sell when the price is going below something to avoid the further losses. That is what we are calling as a stop loss. Similarly, if you have already shorted, you will buy back when the price actually goes down. But if the price is not going down but it is going up, to avoid buying it at even more higher price, you will put a stop loss order so that you can buy it at that price and you can refund it back. So these are the instructions which are associated with the execution part. You execute the trade at this particular price. Then there are some instructions in the market which talk about the validity. How long should this order be valid? You have placed a limit order. See, market order gets executed immediately. But limit order, when the stock price falls below a particular price, only then it gets executed. So what is the validity period for that? Is it during the day? Right? If it does not, see, today it did not come to that price. Stock did not fall. Let's say you have said that I want to buy one share of some X. If the stock price falls below 130 rupees a share. Today it has come only up to 131, but it did not come to 130 at all. Should it wait for tomorrow also, or should it expire today itself? Those are the things associated with the validity instruction. Day orders means they are valid only for the day. Whatever the instruction you have given, if that price touches that mark during the day, it will be executed. Otherwise, it is expired. But if I say GTC order, which is good till cancelled, so it will continue for days and days until you physically cancel that order. It's not an automatic cancellation. If it is a day order, most of our limit orders in our exchanges today are all limit orders. At the end of the day, they all get expired off. But if it is a GTC order, until you physically cancel it, it will keep waiting. Okay, tomorrow will it come down below 130? If it comes below 130 tomorrow, it will execute the buy transaction at that price. So it's not expiring at the end of the day. It's continuing for n number of days. And the third set of instructions are clearing instructions, which are more to do with the settlement process, like T+2 transactions, T+2 day transaction, or the money has to move from this, or probably margin requirements. These are all something to do with the settlement process. The major instructions are execution related and the validity related kind of instructions as far as the trading process is concerned. So market orders, we'll just go through them. So order to execute the trade immediately at the best possible price. That is a market order. The current best possible price, whatever is prevailing in the market, we are executing at that price. The biggest drawback for this is probably it can get executed at an unfavorable price for the buyer. Because suddenly if the stock price has gone up, probably you would be ending up buying at that particular higher price. Because just a few seconds before you placed your trade, someone else has placed a huge buy order, because of which the stock price has suddenly mounted up, and your buy order is getting executed next. It may so happen that your order will be, because you are not specifying any price. You are specifying whatever is the current market price get executed. Because of few milliseconds or seconds change, the markets, if it fluctuates, probably it may get executed at an unfavorable kind of scenario also. Whereas in case of limit order, you are specifying very clearly that you want to buy only if the price goes below this, or you want to sell only if the price goes above this. So you know the price at which you are going to buy or sell. But the only problem is, most of the, in case of it is a day order, there may be a chance that that cannot be executed. I mean, it might be possible that it might not have been executed at all. Right? You say that only buy when the stock price goes below 130, and during the day the stock price never went below 130. Then there is a possibility that it may not be fulfilled at all. That particular order may directly go expired, and it may not be fulfilled at all. Then we are talking about primary versus secondary markets. In the primary markets, we spoke about the new issue of the securities. Whereas after their initial IPO process, they go and get traded on a secondary exchange. The typical IPO process is, we always talk about an underwriting process. Right? Whenever we talk about an underwriting process, it is like investment bank comes into picture, who are the underwriters typically for every issue. They will give the company an assurance that we can sell this many number of shares at this particular price. Right? You can issue these many number of shares at this particular price into the market. So it's just not advisory anymore. Along with the advisory, they also take the ownership in terms of getting those things sold to the customers. Because whenever, let's say, a company wants to sell, whenever a company wants to sell fresh shares to the public, an investment bank comes into picture. So here, if the investment bank acts only as an advisor or an intermediator, right, without taking ownership, if he acts only as a broker in this entire issue, then we call it as a best efforts offering. But if he takes the responsibility of taking all the shares from this party and selling the shares to the public, that kind of offering is called as an underwritten based offering. So if the investment bank is only the broker, like is only acting as a middleman rather than taking the ownership, like if some shares are unsold, company only is responsible for selling them. Whereas in case of underwritten offering, if some shares are unsold, investment bank is responsible for selling them. So that's where in underwritten offering, the commissions are very, very high compared to best efforts underwriting, where the commission which an investment bank charges cannot be much higher, because there is no risk which is taken by the investment bank in that process. Then we also talk about a private placement process, where it's only, see, I'll sell 10% of my shares as a company, but not to the public, but to some private agency. I'll just approach one big investor. That is what we call as private equity investment. I approach one big investor. I ask him to invest a few crores and give him a 10% share in the company. That is what we are calling as private placements. In that, the advantage is, I don't need to approach the public for all this. The disclosure norms will be much, much lesser, because I can just disclose it only to that private equity investor. I don't need to disclose everything to the public. All these things will become more and more profitable when we are going for a private placement kind of a scenario. So in any kind of a country, if the secondary market is very liquid, like quick buying and selling, probably in India, if we see the stock market, it's very, very liquid. Anytime I can buy good number of shares, anytime I can sell good number of shares. In that case, probably raising capital also is a very easy stuff through the issuance of shares and all, because the secondary market is quite active. So even if someone is not satisfied with the share, he should be able to sell it very quickly in the secondary market. So if the secondary market is very, very active and very, very liquid, what we observe is raising capital also becomes very easy in the primary market. Then, okay, coming to the securities market itself, we see different markets using different kinds of mechanisms, right? Typically, when we talk about a brokered market, in any kind of a brokered market, or probably we call them as dealer kind of markets also, wherein the broker acts as a counterparty. He acts as a counterparty, he acts as a seller to a buyer, he acts as a buyer to a seller. That is what we call as a brokered markets. See, if it happens at different points in time, we are calling them as dealers. If the matching is happening at the same point in time, we are calling them as brokered. So the brokered market is nothing but, let's say, a real estate market. There is a brokered market. See, sometimes the real estate agent or real estate broker, what he will do, he acts as if he is a buyer from a seller, and he acts as a seller from a buyer. Right? Though he does not really buy properties and sell properties, the way he positions himself as if he is a seller to a buyer, as if he is a buyer to a seller. So those kind of markets, we are calling them as brokered kind of markets. Then we also talk about quote driven markets, where dealers mainly come into picture. Typically your currencies market, heavily dealt by dealers, right? So that's a quote. Now you go to Western Union money transfer, there are different quotes for buying and selling, probably a dollar, pound, lot of other currencies. They put up the various prices. You go to ICICI Bank, they put up some other prices. You go to HDFC Bank, they put up some other prices. You go to Thomas Cook, they put up some other prices. Because they are all dealer driven markets who put up their own quotes for buying and selling. And those kind of markets, we call them as quote driven kind of markets. Whereas when we say order driven markets, it's a price. One single price between the buyers and sellers. Wherever the orders are matching, at the buy order matching with the sell order, the deal gets executed at that particular price. Those are the typical order driven kind of markets. So different people place their orders for buying and selling. So a buy price is matched with a sell price. Wherever both the prices are matched, a trade is executed. They are all called as the order driven. The buy order is given, the sell order is given. Wherever the price matching occurs, the trade is executed at that particular price. There are also some other names called call markets as well as continuous markets. When the trading happens, or when any buying and transactions happen, only at some specific points in time. Like if you talk about an auction market, all bids are collected, right? All the bids are collected and they are all opened up at one point in time. The buying and selling does not happen throughout the day. When I say it's an auction, whenever the application comes, all of them are open towards the end of the day. Those are what we are calling them as call markets. They happen only at specific points in time. The trading happens only at specific points in time. So probably if I say the matching happens at every 1 hour. The matching, even when you place a trade now, you have to wait for 1 hour to execute your trade. All trades will be opened up at 12 o'clock. So whosoever have placed the trade between 10 o'clock to 12 o'clock, all of them will be matched only at 12 o'clock. They are all called as a call market. But once you place the trade now, immediately the matching happens and buy and sell happen. We call them as continuous markets. So basically, when the market is open, At any point, the trade can typically execute in a continuous market. Mostly the stock markets work as continuous markets itself. Like mutual funds, right? You buy today. Anytime you buy, you will buy at the same price. The NAV is updated only at the end of the day. The net asset value of the mutual fund is updated only at the end of the day. So anytime you buy during the day, whether it is you buy in the morning or in the evening, you will buy at the same price. Because the new NAV is computed based on the end of the day's value. So that is like a call market. But in the stock market, probably after half an hour, if you want to buy, you may have to pay a higher price or a lower price. Which means the trades are executed immediately, which is resulting in the price either going up or going down. And that is what we are calling as continuous markets. So when we are talking of full-fledged financial system, we have already talked about all those things we call as complete markets. Like saving should be there, borrowing should be there, people should be able to manage risk, trading should be quite frequent. And we also talk about operational efficiency in that particular system. Like transaction cost should not be very high. Right? That will happen only if liquidity more, volumes are very high. Only in those cases my trading costs will be very, very low. Only then we say the operation. Otherwise, people will just back out saying, if I have to place one trade, probably if it is going to cost me some 10% or something, then they'll not do a frequent trade there. Typically, if you look at a real estate market today, people will not buy, sell property that frequently also. Compared to a stock market, the buying and selling in a real estate market is much lesser compared to the buying and selling in a stock market. Because the trading costs are not so low in case of a real estate market. Right? Then, informational efficiency. Whatever the news that is available, right? Probably a company's new project information coming up, or new recruitments at a company coming up. Whatever the news that is coming up, it is getting reflected into the prices very quickly. That is what we are calling as informational efficiency. And in any financial system, we should also see the allocational efficiency, which means whatever the capital that is raised, it is put towards the better usage so that it can generate better returns and contribute to the growth of the economy. Because only if it generates a growth, the investor will get some kind of a return on whatever he has invested. So the capital should be put to a very better use. See, a bank can give you 8% return on your investment only if they are able to generate a 12% return out of your money. Right? So, the capital, whatever is coming into the system, it should be put to a much better use, which can generate much better return. Only then the financial system can furnish the required rate of return for the investors. So all these things should be looked at as a part of efficiently functioning financial system of the country. So because of that reason, we see that there are regulators that are present in the market like SEBI or SEC for US. There are various kinds of regulators. In insurance, we have IRDA. In banking, we have RBI. All these are kind of regulators that are present for those particular kind of markets where from an investment or from an equity market standpoint, we have SEBI, US as SEC. All these things, again, their main intentions are protect the unsophisticated investors, under the understanding that most of the investors, they are putting money just to make profits, but they don't know how those companies function. So to protect the needs of the unsophisticated investors, make sure that the companies are not trying to use the money of the investors for wrong deeds. All these things SEBI is intervening. and it is helping the investors evaluate the performance of the companies. It is making mandatory that every company has to file the financial statements, including all this information, so that investors can know the performance of the company at the end of every quarter or at the end of every year. And it is also putting some rules where it can prevent the insiders from exploiting the investors, because the directors and all, they are the guys who know the information about the company in advance, right? Which projects we are going to get, because they are the guys who deal with all these things. Now, the SEBI or any regulator will make sure that these guys don't buy the shares before the information goes to the public and get an extra advantage of increase in the share price. Then public will feel very much disgusted and they may not even buy the shares of that company, because anyone is investing with an intention that he will make a profit. But if the insiders are making much bigger profit than a regular normal unsophisticated investor, the investor will not come forward for any kind of investment. So that is what we are saying. That is what is one of the roles of the regulator, to make sure, to come up with the rules to make sure that the insiders don't exploit the other regular investors. So financial reporting kind of requirements and all you make set, so that the companies can easily publish all that, and even the analysts or probably the investor, he should be able to obtain all the key information about the performance of the company in a very simple, without cost kind of a manner, because he for him, if the information is available for almost free, he would be able to evaluate the performance very easily. But if there is a cost associated with it, again he may back out in terms of evaluating the performance, which will make the system again not well well versed kind of a financial system, or well sophisticated kind of a financial system. So the regulator will typically intervene and make sure that all these things are aptly adhered to.